And the reason why they want to try and push the market towards those lows is because they know that rookie traders and careless professionals will put their stops somewhere around here, either exactly at the low or inside of this zone. And it's just because traders are creatures of habits and they've been trained to do it that way. It's the same reason why traders will put stops in this zone of highs. So if they're short, they'll have their stops up in here. So a trader is going to try and push the market into that area to trigger the stops because he knows that he can pop the market a little bit. Okay? So if the trader is going to push the market and attempt to get the market to this area, doesn't it make sense to avoid that area? Well, absolutely. You wouldn't want to place your stop where it has the highest probability of getting stopped out, which is why you should avoid stopping out exactly on moving averages. You should avoid stopping out exactly at highs or exactly at lows. You should always place your stop a bit beyond them, simply because there's a tendency for traders to try and push the market into those areas in order to trigger stops so that they can make money. And they know that all of that's basically like money they're picking up off the street. It's like found money for them. They don't have to work a bit for it. So, let me pause and take a drink. How does all of this fit into the trading tactics and the fundamentals, if you will, of trading? Well, first of all, when we're trading, we're looking for points of momentum. Remember, we're at the core here, we're looking for conservative ways to aggressively make money. Now, we're in the Forex market, so right away we're aggressively making money. I mean, we're leveraging our money 50 to 1, 100 to 1. Okay, huge amounts of leverage that we're putting into the market. Okay, so right there, that is very aggressive. So we don't need to add to this. We don't need to compound this issue. Now, in order to trade conservatively, then we need to trade high probability setups by following the normal conventions of the market. And that's, that's basically a fancy way of saying we need to look for things that other traders are looking for. And that's why we look to trade when the market breaks out over highs, when the market breaks through trend lines. So when the market pushes through things like this, we possibly can have a trend, possibly have a trade if it lines up with the overall trend. Because if the market is moving in an overall trend, let me tie this all together for you very quickly. If the market is moving in an overall trend, what that means, let me switch to a bigger chart here and change the scaling. If the market is moving in a bigger trend, like we can see here on these 4-hour bars, what this means is the market participants have a singular direction that they're thinking. They're thinking up. Well, what that means is most of the customer orders then are going to be buy orders. If most of the customer orders were sell orders, the market would be moving down, right? Remember, it's all supply and demand. Supply is selling, demand is buying. It's very, very simple. So, if we're trading with the overall trend, what do we know about the way now market makers and the guys that are running the show, what do we know about the way that they work? Well, we know that if they have a big order to buy, let's say they have a big order to buy down in here, they're going to try and push the market in that direction. If they know that there are big orders to sell, they're going to push the market in that direction.